Okay, so I had mentioned that there's this category of company of tax classification that is kind of a hybrid. These are S corporations. They are like partnerships in some respects. They're like C corporations in other respects. Subchapter S, so we call them S corps. This is a company that has elected to be taxed under these provisions, and it's subchapter S of the Internal Revenue Code where that falls. Now, a S corporation could be an LLC. This is just a tax entity. Okay, so it could be a LLC, a limited liability company. It could be a partnership that's chosen to be taxed as an S corporation. That would then change it from a partnership to an S corporation, but it could have been organized as a partnership before. It could be just a single individual that owns the S corporation. So it's not a legal entity, it's a tax entity. Just like the LLC, remember, is not a tax entity, it's a legal entity. With these S corporations, they're tax entities, they're not legal entities. But oftentimes they are, for legal purposes, they're LLCs or they're PCs. Has anybody ever seen that terminology used? Like they'll have the company name and then comma PC. That stands for professional corporation. And that's a corporation. That is a classification of legal organization under the state. And a professional corporation, you usually see them with lawyers, doctors groups, architects, accountants. What a PC is a classification of corporation that is organized by a group of professionals. So they have to be majority owned by people that are working in that profession. So a lot of PCs that's how they're organized for legal purposes, but they choose to be taxed as an S corporation. So like I said, it is a flow-through entity, so it does not pay income tax at the entity level. So all that stuff that we talked about with regard to partnerships, that flow-through part, that applies to S corporations as well. So individuals who are owners in an S corporation will receive a K-1 from that S corporation. So just like the partnerships have a Form K-1, S corporations have a K-1. One difference between partnerships and S corporations, though, is that, remember I said with partnerships, the owners they can't be employees of the partnership, right? They're just, their income is going to be in the form of guaranteed payments. They're going to pay self-employment tax on that income. They've got to report all of that and be responsible for that themselves. With S corporations, it's different. The owners can be employees also of the S corporation. In fact, the IRS looks at S corporations and makes sure that any owners that are providing services are receiving W-2 wages. Because one of the things with the S corporations, you can avoid, there isn't any self-employment tax on the income that's reported on the K-1. So S corp owners have tried, many of them succeed, but it's illegal. But what they'll try to do is they'll try to get that income in the form of distributions from the S corp when it really should have been a salary. It should have been reported on a W-2, and if it was reported on a W-2, it would have been subject to income tax, it would have been subject to federal and state income tax, Social Security tax, Medicare tax. But if they take it as a distribution from the S corp, then suddenly it's not taxable to them. So, but the IRS is wise to that, and they look at S corporations specifically for that purpose. Tax returns are due on the 15th day of the third month. So usually it's March 15th for calendar year. They are permitted a 6-month extension In order to be an S corporation, elect an S corporation status, all of these things have to be present. Has to be a domestic corporation. Foreign corporations cannot be S corporations. There have to be 100 or fewer shareholders who are all either individuals, estates, or trusts. So a C corporation cannot own an S corporation. A partnership cannot own an S corporation. Only individuals, estates, and certain trusts can own part of a share of an S corporation. The shareholders, by the way, a married couple is considered a shareholder. So really, if you could have 200 individuals if they were all married couples, but that's one of the requirements. So really, this is for smaller companies, is what it's designed for. Can only have one class of stock, and the shareholders have to be U.S. citizens or resident aliens. They cannot be non-resident aliens. They cannot be non-U.S. citizens. So it's only for U.S. individuals, a U.S. company of 100 individuals or more. If any of these things changes, then the S corporation ceases to exist. Or it doesn't cease to, the S corp election is no longer valid. So it would automatically, I think, become a partnership probably in this case. So for example, if they admitted as an owner somebody who is not a U.S. citizen or resident alien, that would immediately trigger the S corp election to be canceled at that point. What else do I want to say? S corp election is valid until it's statutorily terminated or voluntarily revoked, meaning if it doesn't meet those requirements, that would be the statutorily terminated. It can be revoked voluntarily as well. One of the things that happened with the 2017 Tax Act, because they lowered the income tax rate for C corporations by such a significant amount, at least for a lot of C corporations, and a flat 21%, there are a lot of S corporations that decided to become C corporations instead because their owners were in higher tax brackets, and so they were paying, like, this is a flow-through entity, so the owners are going to pay tax at whatever their individual tax rate is. So if they're in a 37% tax bracket, they're paying 37% tax on the income from this S corporation. Well, Congress changed the C corporation tax rates down to 21%. It's more advantageous if just the corporation pays it and at that lower tax rate. So there were a lot of companies that decided to switch over to C Corp, but I did a lot of S corporation returns when I was practicing. I would venture to guess there are fewer now. I'd be doing fewer, but it's still a pretty popular form of corporation. So it has, just like the partnership, we've got taxable income, ordinary income, and separately stated items. So all those things that we talked about with the partnership return still apply. This is what the tax form looks like. It's an 1120S, so 1120, just like the C corporation, but it's got that S at the end. Same sort of setup, like an income statement. On that first page, lots of yes or no questions about ownership, all of that stuff. We also have a Schedule K. So remember, we looked at the Schedule K with the partnership return. We have a Schedule K for the S Corp return. And it corresponds to the Schedule K1s that the owners receive. We've got a balance sheet here, same requirements. If it's $250,000 more of assets or gross income, you have to fill out the balance sheet. And we've got an M1 as well, reconciliation, just like what we talked about with the C Corp. Just like with the partnership, it's all based on ownership. So the income is divided up based on how much ownership. So here we've got Pitt Company is an S Corp, 2 shareholders, Tamar and Zeke. They own 60% and 40% of the corporation. During the year, Pitt has income of $50,000, which includes $3,000 of dividend income, $1,000 of charitable contributions. So their S taxable income is $48,000. So this is how that $48,000 would be allocated. $48,000, 60% to Tamar, 40% to Zeke. And again, the dividend income, same thing. Charitable contribution, same. So just like the partnerships, it was divvied up based on ownership percentage basis. So we're going to end talking about basis again. So with the S corporation, we're not going to get as involved as we did with the partnership. You're already familiar with kind of how all of that works. It works the same way with the S corporations. That basis is continually tracked with an S corporation, just like it is with a partnership. So, and these are the items that increase basis for an S corporation. You can see they're the same items that increase basis for a partnership. Income, any separately stated income items, any additional capital contributions, loans from the shareholder to the corporation, and then decreases in basis result from net losses, separately stated expense items, and any distributions from the corporation at fair market value. Also, any loans from the corporation to the individual would also decrease it. Again, we cannot go below zero for basis. Okay, so just like with the partnership, with like anything, basis can never go below zero. Doesn't matter if it's for partnerships or S corporations, or if we're talking about assets and their basis, it can never go below zero. Any excess is going to first reduce the basis of any loans. If any remains, it's going to be suspended at that point. So what happens is it just kind of remains in the air until such time as there is income to absorb those that basis reduction. What else do I want to say here? Schedule M1, we've got the Schedule M1 for S Corps as well. So that's about it. That's all I want to say about the S Corps.